My wonderful family, welcome to Unit 3, Part A of our course. I hope you guys have all been good, hey? Well, without any waste of time, let us read the disclaimer here. Well, read it yourself. And then you can pause the video if you feel like you want to do that, but ensure that you read the disclaimer. Welcome to Unit 3. In Unit 3, we will be learning about supply and demand under the concept of smart money. So we will be learning supply and demand under smart money concept. Okay? Sure. Let us see what we are going to be talking about. So in this unit here, we have what we call order blocks. Okay? Order blocks. So we will be introducing to you order blocks, and we have a standard order block, a hidden order block, a breaker block, and a mitigation block. So I will be showing you guys what kind of things are these that we will be talking about. Maybe you ask yourself, what are order blocks? Well, let us read here. Order blocks refer to specific price areas where large market participants such as institutional traders have previously placed significant buy or sell orders. Okay, for example, let's say the market goes up, okay, and then as the market goes up, it drops and goes down, and on that drop, it happens that the market leaves an FTR which was bullish, a bullish FTR which is a bearish FTR which was a bullish candle, and then as the market drops from that bearish FTR, it comes back from that bearish FTR after forming the lower low, and then what happens is that when it comes back to that bearish FTR, you will see that that is what we expect to be an FTB. Remember from the previous lessons, right? So by saying that, by the way, if this is your first time in our channel, please like, subscribe, share the video with as many people as you can, and know that there are other videos prior to this one. This is just an extension of our course. This is a continuation of our course. As you can see, now we are in Unit 3. So we had Unit 1, Unit 2, and they've been made available for you. So just check them under our channel and learn as much as you can. Okay, so let me not waste any time, guys, and start explaining to you what let's dive deep into it. So check this out. This is an introduction to order blocks, right? So we have something here that it's written a bullish OB, which is order block, is the last bearish candle. Well, that's not always the case, but that is what happens in the majority of times. And a bearish order block is the last bullish candle. Okay, so let us look here. The market dropped a little bit, went up, and then just before the drop here, just before the market drops here, just before this drop here, the market left this candle here, that candle, we will mark it up with a zone like this, and then we will refer to that candle as the last bullish candle before the market dropped, and we call that a bearish order block. Okay, and as the market is below that point, above is our supply zone. Okay, so this zone that has been highlighted above is called our supply zone. It's a bearish order block. Okay, so as you can see, the market dropped, and as it dropped, it broke this previous low here to go and form a lower low, and then just after forming this lower low here, it went back up and retested on the order block. And as it retests on the order block, that is where we will be looking for our sell entries, and then we come here, we look for whatever confirmation that we are going to see, and then that's where we take our sell entry, and you will use the previous low in this case because we have not dived deep into the course. This is just the simplest term of it. You can use this previous low here as your target, and you put your stop loss above the most recent high in this case it was above these recent lows here, you know. So that is what we call a bearish order block, and then we sell there, we put our stop loss above the order block, and then we use the most recent, you know, low as our target. Okay, so this is just a standard order block. Okay, and then in this case the market went up. It's a bullish scenario now. The market went up, came back down just after forming this high here. It went back down to form a low, and then after forming this low it went up. But mind you that as the market went up, we are able to see that it left the last bearish candle, and this bearish candle, you'll find that sometimes it has wicks, you know, just like this bullish candle there. You'll find that sometimes it has wicks, tails, or shadows, you know, and then when you highlight it, you can highlight it with all its tails, but they don't have to be, you know, ridiculously very long, you know. And then yeah, you highlight that zone there, we call it a demand zone. Okay, we call it a demand zone. So if you want to know more about why is it called a demand, why is it called a supply, I suggest for you to find a way to communicate with us, and you know, in the description we'll make a way that you find our contacts, you know, and then find a way to communicate with us via Facebook, via X, and WhatsApp, you know, and then join our mentorship program that comes after this, you know, this unit 3 right now. I will be teaching you guys up to unit 3 part C, you know. Unit 3, is it part C? We'll see about that, but I just want you to know that there will be, you know, a program set specifically for those who will join our mentorship program. There are going to be videos there that are very much detailed, advanced, and we will be teaching you how to combine everything that you've learned, especially when it comes to supply and demand. So I'm just saying this so that you may know that this is not like, you know, where we end, you know, there's more beyond this that you can learn from. But then let us proceed. You know, as you can see, the market rose from this change of character here, went up, and then it dropped. So I want you to be aware that sometimes the market will leave an FTR just maybe somewhere here, you know, just in the middle somewhere there as it rises before it can even form that change of character. So if the market leaves an FTR candle there, you will consider that FTR candle as your order block, as your demand zone in this case. Remember, demand is the one below and supply is the one above. So you will mark that candle. If maybe this candle was a bullish FTR, which was going to be a bearish candle in some instances, then you would have marked that as you would mark that as your, you know, your demand zone. Okay, yeah. So in this case there was no there was no bullish, you know, FTR here. The only last bearish candle that we identify is this one here. Okay, so you will target that candle, and that candle becomes what we call your point of interest, because that's where you will be interested in looking for your buys, you know. Yeah, so as the market came to this point, you start analyzing, stepping down into smaller time frames. Maybe in a smaller time frame you will find another scenario that looks exactly that like this one. You'll find that as the market approached your demand zone, maybe it gave you something that ended up, you know, showing a structure of change of character to the upside, leaving another smaller order block in a smaller time frame. You can target that. You know, like I said, the market is fractal, so whatever that you see in a bigger time frame, you can also see it in a smaller time frame, and the more you see that having confluence in smaller and smaller and smaller time frames, you can use those to refine your entry so that you will not be easily stopped out. Okay, so in this case you would buy here, and then you put your stop loss below the most recent low, and then the high that was the most recent, it becomes your target, and that's it. Okay, so this is just the standard order block. Let us move. Now here we have what we call hidden order blocks. Okay, so in the case of a hidden order block that is bearish, you will see a candle that is representing the sellers, you know, forming, and then just at the closing of that candle, you'll find that it has a wick to the lower side, and then the following candle closes and it has a wick to the upside. So these candles here, their wicks are interlocked. Can you see that? They are interlocked. It's like the other one is pointing downwards and the other one is pointing upward. So here in this kind of thing here, you can mark it as a zone, and then that is where you will find your hidden order block when you go down to smaller time frames. Some people, they just happen to know that now this is called a hidden order block, but they don't really know why it's called a hidden order block. So it's called a hidden order block because if you step down, okay, let's say maybe this was a daily time frame, and then you step down to 4 hours, you'll find that as this candle was dropping here, it formed a low, okay, and then the market went up a little bit to correct. You know, this here, the market was going up a little bit to correct, and that's why you can see this is a low and this is a high. And at this high here, which is our most recent high, you know, just at the end of this week here, at the end of this shadow here, it's our most recent high. Okay, so if you step down to a smaller time frame in this scenario, you will find a bearish order block there, which might be a bullish candle. Okay, you might find something like this, guys. Okay, you'll find that the market was dropping, and that drop there is what created the wick, the candle shadow, the tail of that candle. And then as the market went up, this movement that is going up, it was that second candle, and then it creates a high, you know, and then it drops. So I just came back here to make that, you know, explanation so that maybe it can open up your mind into understanding what I'm trying to explain. So that was the drop, and then this was the consolidation somewhere there, that was the correction, and then somewhere there in a smaller time frame you'll find a hidden order block. But then we call it hidden here because it's not visible to the naked eye. It requires somebody to step down into a smaller time frame. Okay, so you just mark this zone there, and then if you don't like, you know, stepping down into smaller time frames, you prefer trading the high time frames, and you just want to put your pending orders there, maybe you want to put your sell limit there, then what you will do is put your sell limit here, put your stop loss above, or you can sell immediately when the market comes here after it gives you a confirmation, and then you will target whatever point you want to target below. Okay, so in order for you to learn more about where to have like your most reliable targets, that is something that we will teach you guys more in the advanced course from this unit part, you know, this unit 3 here. We will teach you more on that in the advanced course in our mentorship program. So if you want to join our mentorship program, remember you can contact us and then communicate with us, and we will, you know, help you with that. Okay, so in this case the market was dropping from the low here, went up from the high here, you know, this high, and then this high broke this one, and then from this high here goes down and then forms this low. In this case, these are only wicks, but they are interlocked. So this is marked as a hidden order block. You know, it's a hidden OB, guys. And then the market rises, goes up. As it comes down, you'll find that somewhere here it has created a change of character. Okay, so as soon as you see a change of character, you come and check within that zone, you know, what did the market leave behind? What is it that the market left behind? And then as soon as you see an FTR candle or a hidden order block, like in this case, that's where you will be looking for your entries. Okay, let's proceed. Now, here we have a breaker block. It's still an order block. Okay, it is an order block. Check this out. The market it was coming from this side, went up to form a high, came back here from the low, went up. What was the most recent bearish candle? It was this red candle here. And remember what we said, a bullish order block is the last bearish candle. What was the recent candle that was bearish here? It was this one. Okay, so we mark that candle. As the market goes up, we are hoping to buy. We are hoping to buy when the market comes back to this point. But check this out. What happens is that when the market gets there, it actually breaks this zone. You know, it broke the high and went up, and then comes to break this zone and break this lower low and go down. So you can hear that there are so many breaks there. So that's why we call it a breaker block. Well, this may not be somebody else's explanation, but that's how I believe I can help you remember it easily. Okay, so this is a breaker block. Why? Because the market, from this thrust here that was going to the upside, it broke the previous high, and then this drop here broke the previous low and mitigated our order block to the downside. It broke the order block to the downside, and we call that a breaker block. Now, this order block has been broken, right? But since we have marked this zone there, there's a high possibility that as soon as the market comes back to this zone, you find that it's a strong zone. Why? Because once resistance is broken, it turns into support in many cases, and once support is broken, it turns into resistance in many cases. So this zone here, as the market went up, it was a support zone, but as soon as the market breaks it, it turns out to become a resistance, you know. So that's why we look for our sales there, and then we put our stop losses above the most recent high. Let me say we put our stop losses above this zone, okay, and then we will target whatever that we will be targeting on the left hand side. Okay, and mind you, this is an M kind of a shape, of which you and I can identify it as a double top because there are two tops above. Okay, so remember what I said when I told you guys on unit 1 about double tops and double bottom. I said you don't just sell immediately when you see one. You have to wait for a breaker to the downside or to the upside, you know, a breaker to the other side of the neckline. And in this case here, was our neckline. They broke it to the downside, and we would look for sells there, and we would use a distance from one of the legs, you know. So like I said, guys, there are people that can try to bash your strategy, but when you look at them all, you find that you can end up taking an entry that, when you explain it to someone, they may not understand why you took that entry. But then when you look at the level where they took their entry, it's just the same level as yours. Why? Because we all are looking at the same graph, same chart, maybe same time frame, but our interpretation on the market will never be the same according to the strategies that we have learned. Okay, so in this case, the market dropped from the low, went up from the high, and then dropped. Okay, and then as it drops to form a lower low here, it broke this previous low. Okay, and then as it breaks this previous low, it goes back up, and we were anticipating to sell on the order block, which was the last bullish candle. Okay, and then what do we see? We see that the market was moving with a huge thrustical momentum to the upside, then broke that order block, went again to break that high, you know. So this is a breaker block, you know. This is a bullish case in here, and then the market forms this higher high. We don't know where this higher high will be, and then comes back down. As it comes back down, this from the downside, when you look at it from the downside, you can see that this zone was supposed to be a resistance, but they break the resistance. So that's why I said to you guys, you don't just sell when the market gets to a resistance. You don't just buy when the market gets to support. You always look for confirmations, like I explained when it comes to the FTR, you know, that it can act as a continuation signaling candle, you know. Yes, so in this case, the market broke this and then went up. When it came down, that's where we look for our buy entries. All right, let us proceed, guys. Now here we have what we call a mitigation block. Okay, mitigation block, let me explain to you what it means. The market rises, forms a higher high, drops, forms a low, go back up, forms a lower high, and then it drops. As the market went up, there was the last bearish candle here, in as much as there's the last bullish candle there. So we can say that we had a bearish order block there, and then we have a bullish order block there, you know, and then now the market is playing in between. And then what do we expect to do, guys? We have marked this zone here as our support zone, right? And the market is above, right? Which means this was our demand zone, because I said demand is below and supply is high. And then the market now drops. We expect to buy on this demand zone, but when the market gets there, we don't get to see what confirms a bullish momentum for us. Maybe we see a bearish FTR signaling that the market may drop, and then of course the market drops, you know. So this high here failed to take out that previous high. In other words, it failed to break the previous high, but instead the market turned and went to mitigate, to violate this order blocks principle, you know. And then that's why we call it a mitigation block. And then as soon as the market mitigated this order block, went to the downside from the lower low, came back up came back up here, and then we expect to sell. Why? Because as soon as they break this demand zone, the demand turns into supply. Okay, and then as the market drops, that zone now, it becomes our supply zone, and then we aim to sell on supply. So I want you to always remember that whenever they talk about supply, you should always think about selling. When they talk about demand, you should think about buy, you know. Yes. So in this case, the market from the lower low went up to form the high, came back to form a higher low, broke that previous order block, which we would have identified there as the last bullish candle. And in this case, I'm very sorry for this, you know, confusion that I made with these candlesticks here, but I hope you do understand. Like I said, you can customize the candles in whatever color you prefer, but the market structure will always tell you whether those candles are bearish or bullish. Okay, so the market broke this candle here and then went up, and that now what was supply, it becomes demand zone. Okay, and then we look forward on demand, look for buys. Okay, so that is it, guys. And as this low failed to take out this high, we call it a failure swing high. This low failed, this high here failed, this low failed to take this previous lower low, right? It failed to go beyond the lower low. It came back here and went up. So we call it a failure swing low. Okay, guys. This is the end of part A in unit 3. And for this unit, guys, I will not be showing you any practicals. I want to challenge you to go on the market, look for these things that you just learned in here, make screenshots if possible, send them to us, and, you know, let us have them discussed with you so that we can see that what you are learning, you are being able to put into practical. Okay, thank you very much, guys. God bless you all.